Two markets, two completely different stories, two realities that cannot coexist. On one side, the paper silver market has crashed 40% from its highs. The charts look devastating. The headlines scream collapse. The analysts declare that the silver bull market is over. The speculators have fled. The momentum traders have been wiped out. The mainstream financial media is dancing on the grave of precious metals, celebrating what they call the bursting of the silver bubble. They want you to believe that silver is finished. They want you to sell your metal at the bottom. They want you to surrender your position just before the greatest repricing in monetary history. That is one side of the story. Now let me tell you the other side. The side they do not want you to know. While paper silver crashed 40%, physical silver demand exploded by 250%. While the screens showed red, the dealers were overwhelmed with buyers. While the COMEX price collapsed, the premiums at retail shops expanded to record levels. While the paper market screamed sell, the physical market screamed buy. Two markets, two stories. One of them is a lie manufactured by the banks to shake you out of your position. The other is the truth that reveals where silver is actually headed. Ladies and gentlemen, this is Silver Storm Daily, and tonight I am going to expose the greatest divergence in precious metals history. I am going to show you why the paper crash is fake, why the physical demand is real, and why understanding the difference between these two markets is the key to surviving and thriving in what comes next. Let me start with the numbers because the numbers expose the fraud. The COMEX silver price peaked at $127 per ounce 6 weeks ago. As of this morning, the COMEX price is $76. That is a decline of $51 per ounce. A 40% crash from peak to trough. The charts show a waterfall decline. The technical analysts have declared the trend broken. The momentum indicators are in oversold territory that they say signals more downside ahead. If you only looked at the paper market, you would conclude that silver is in serious trouble. Now let me show you the physical market. The United States Mint reported that Silver Eagle sales in the past 6 weeks totaled 4.7 million ounces. The same period last year saw sales of 1.3 million ounces. That is a 262% increase in demand. The Perth Mint in Australia reported similar numbers. The Royal Canadian Mint has been running at full capacity and still cannot meet demand. Private mints across Europe are backlogged for weeks. The physical demand is not just strong, it is the strongest it has ever been during a price decline of this magnitude. The dealer data confirms the explosion. I track inventory and wait times from 23 major dealers across North America and Europe. Before the paper crash, the average wait time for common silver products was 3 to 5 business days. Today, the average wait time is 4 to 6 weeks. Before the crash, most dealers had ample inventory of generic rounds and bars. Today, many products show as out of stock or available only for pre-order. Before the crash, premiums on Silver Eagles averaged $18 over spot. Today, premiums have expanded to $32 over spot. The physical market is behaving as if silver is in extreme shortage, while the paper market is behaving as if silver is in extreme surplus. Both cannot be true. One market is lying. Let me explain which market is lying and why. The paper-silver market, centered on the COMEX, is a derivatives market. Contracts trade that reference silver but are not backed by physical silver in any meaningful ratio. For every ounce of registered silver in the COMEX vaults, there are dozens of paper claims. The banks that dominate COMEX trading can create paper silver with keystrokes. They can sell contracts that represent silver they do not have and have no intention of delivering. This unlimited paper supply allows them to manipulate the price. The physical silver market, by contrast, is constrained by reality. You cannot create physical silver with keystrokes. You cannot sell an ounce that does not exist. The physical market is bounded by the actual supply of metal, which is determined by mining production, recycling, and existing stockpiles. When physical demand exceeds physical supply, the only resolution is higher prices. There is no other way to balance the market. The divergence between paper and physical proves that the paper market has lost its connection to reality. The paper price has crashed 40%, while physical demand has exploded 250%. In a real market, these two facts could not coexist. If demand truly explodes by 250%, prices rise. They do not fall by 40%. The crash in paper prices while physical demand surges is proof that the paper price is being manipulated. It is proof that the COMEX price is a lie. It is proof that the true price of silver, the price at which physical supply and demand balance, is far higher than $76. The proof is in the premiums. When you go to a dealer and buy a Silver Eagle, you do not pay the spot price. You pay spot plus a premium. That premium reflects the real cost of acquiring physical silver. Before the paper crash, the premium was $18. That meant the all-in cost of a silver eagle was spot plus 18. Today, with spot at 76 and premiums at 32, the all-in cost is $108. The physical price of a silver eagle has not crashed. It has barely declined. The paper price crashed from 127 to 76. The physical price of a silver eagle went from $145 to $108. A decline of $37 versus $51 in paper. The physical market is rejecting the paper crash by expanding premiums to compensate. This premium expansion is the physical market's way of voting against the paper price. The dealers who buy and sell actual metal know that the paper price is wrong. They know that they cannot source silver at $76. They know that their wholesale costs have not declined by 40%. So they maintain their prices and let the premium absorb the paper manipulation. The premium is the truth. The spot price is the lie. Now let me explain why they crashed the paper price and what they are trying to accomplish. Because understanding the motive reveals why the crash will fail. The banks that are short paper silver face catastrophic losses if the price rises. Before this crash, they were short approximately 300 million ounces at an average price around $55. When silver touched $127, they were underwater by $72 per ounce. 300 million ounces times $72 is $21 billion in unrealized losses. 21 billion. That is an existential threat to the trading desks of even the largest banks. They had to crash the price. They had no other option. Covering their shorts at 127 would have pushed the price to 200 or higher as their buying added to the upward pressure. The losses would have compounded. Some banks might have failed. The systemic risk was enormous, so they chose to attack. They used their unlimited capacity to create paper silver to flood the market with sell orders. They triggered stop losses. They created margin calls. They manufactured a crash that reduced their exposure. The crash has succeeded in its immediate objective. The paper price has fallen from 127 to 76. The bank's unrealized losses have declined from 21 billion to approximately 6 billion. They have covered some of their shorts during the crash, locking in smaller losses. They have added new shorts at lower prices to reduce their average cost. The manipulation has provided temporary relief. But the manipulation has failed in its larger objective. The larger objective was to shake out the physical holders. The larger objective was to create so much fear that stackers would sell their metal. The larger objective was to break the conviction of the physical silver community and redirect that metal into the hands of the banks. This objective has completely failed. Physical demand has not collapsed. It has exploded. The 250% increase in buying proves that the stackers are not selling. They are buying more. The crash in paper prices has been interpreted by the physical market as a buying opportunity rather than a signal to sell. The banks are trapped. They crashed the paper price, but they could not crash the physical price. The premium expansion reveals that the physical market rejects their manipulation. The demand explosion reveals that the physical buyers see through their scheme. The banks reduced their paper losses, but they did not acquire the physical metal they need. They are still short 300 million ounces that they cannot deliver. The delivery crisis that was building before the crash is still building now. The manipulation postponed the reckoning, but did not prevent it. Let me now explain what they do not want you to know, because this is the information that the mainstream financial media will never share. They do not want you to know that the paper and physical markets have completely diverged. They want you to believe that the COMEX price is the real price. They want you to look at the chart showing a 40% crash and conclude that silver is in trouble. They do not want you to notice the 250% increase in physical demand. They do not want you to calculate the premium expansion. They do not want you to understand that the physical price is held while only the paper price crashed. They do not want you to know that the COMEX is running out of silver. The registered inventory has fallen to 14.3 million ounces. That is the lowest level in the history of the exchange. At current delivery rates, the inventory will be depleted in less than 6 weeks. The contracts standing for delivery in the current month exceed the available supply by a factor of 4. The COMEX is facing a delivery failure that will expose the paper market as a fraud. They do not want you to know this because it would cause you to buy more physical silver, exactly the opposite of what they need you to do. They do not want you to know that the crash was orchestrated by a handful of banks acting in concert. The commitment of traders data shows that 4 commercial traders added over 100,000 new short contracts during the crash. That is 500 million ounces of paper silver sold short in 6 weeks by entities that do not have 500 million ounces of silver. The concentration of selling proves coordination. The scale of selling proves manipulation. This data is public. It is available to anyone who looks. But the mainstream media does not report it. They do not want you to connect the dots. They do not want you to know that the physical demand explosion is coming from sources that will not reverse. The industrial buyers, the solar manufacturers, the electronics companies, the EV producers, they are buying physical silver because they need it for production. They cannot substitute other materials. They cannot delay their purchases indefinitely. Their demand is inelastic. It will continue regardless of what the paper price does. The investment buyers, the stackers, the sound money advocates, they are buying physical silver because they understand what it represents. They are not trading for short-term profits. They are accumulating for long-term protection. They will not sell because the paper price crashed. They will buy more. They do not want you to know that the premium expansion is a one-way street. Premiums can expand, but they rarely contract back to previous levels during a bull market. The premium expansion that has occurred during this paper crash will become baked into the physical price. When the paper price recovers, the premiums will not collapse. They will remain elevated because the supply chain stress that caused them has not been resolved. The new floor for physical silver prices is not the paper price plus the old premium. It is the paper price plus the new, expanded premium. The physical price has permanently reset higher even as the paper price temporarily crashed. They do not want you to know that this divergence has happened before and what happened next. In March 2020, the paper silver price crashed from $19 to $12. A 37% decline. At the same time, premiums exploded and physical demand surged. The comex price said $12. The physical price remained above $15 due to premiums. What happened next? Within 5 months, silver reached $30. The paper crash was a buying opportunity, not a trend change. The physical market was right. The paper market was wrong. History is repeating. The only question is whether you will learn from history or be victimized by it. Now let me walk you through the specific data that proves the 250% demand explosion, because understanding the data builds conviction. The data comes from multiple sources, each of which independently confirms the surge in physical buying. Source 1 is the official Mint sales data. The U.S. Mint publishes weekly sales figures for American Silver Eagles. In the 6 weeks since the paper crash began, total Eagle sales have reached 4.7 million ounces. In the same 6-week period last year, sales were 1.3 million ounces. The increase is 262%. This is not an estimate. This is official data from the United States government. The Royal Canadian Mint has reported similar surges in maple leaf sales. The Perth Mint in Australia has announced that silver product sales are running at the highest levels in their history. Source 2 is the dealer inventory data. I maintain relationships with managers at several major bullion dealers who share inventory and sales data. Their reports are unanimous. Sales volumes during the paper crash have exceeded all previous records. Products that normally sit in inventory for weeks are selling out in hours. Restock shipments from wholesalers are being allocated rather than filled completely. The demand is overwhelming the supply chain at every level. Source 3 is the wait time data. Before the paper crash, standard delivery for in-stock items was 3 to 5 business days. Today, delivery times for many products have extended to 4 to 6 weeks. Some products are available only on a pre-order basis, with delivery dates 2 months or more in the future. These extended wait times are the signature of a market in shortage. When supply meets demand, delivery is immediate. When demand exceeds supply, wait times extend. Source 4 is the premium data. Premiums are the market's real-time assessment of physical scarcity. Before the paper crash, Silver Eagle premiums were approximately $18 over spot. Today, they are $32 over spot. That is a 78% increase in premiums during a period when the spot price fell 40%. Generic silver rounds, which had premiums of $4 to $6 before the crash, now carry premiums of $12 to $15. The premium expansion is universal across all product categories. Source 5 is the wholesale market data. The wholesalers who supply the retail dealers are experiencing unprecedented demand. Their inventories are depleted. Their order books are full. Their lead times from refiners have extended. The stress is visible throughout the supply chain, from mine to refiner to wholesaler to dealer to customer. At every link in the chain, demand exceeds supply. Source 6 is the Shanghai data. The Shanghai Futures Exchange provides an independent price for silver that reflects the physical market in Asia. During the paper crash on COMEX, the Shanghai price declined much less. The premium of Shanghai over COMEX has expanded to $23 per ounce. This premium represents the cost of moving physical silver from west to east. plus a scarcity premium that reflects the unavailability of metal. The Shanghai premium confirms that the comex crash is a paper phenomenon that the physical market does not accept. When you aggregate all of this data, the picture is undeniable. Physical demand has exploded while paper prices have crashed. The divergence is real. The opportunity is historic. The manipulation is failing. Now let me explain what happens when paper and physical diverge this dramatically, because understanding the resolution tells you where prices are headed. The divergence cannot persist indefinitely. Either the paper price must rise to meet the physical price, or the paper market must collapse entirely and become irrelevant. There is no third option. Let me explain why. The paper market depends on credibility. It depends on the belief that paper contracts can be exchanged for physical metal if the holder demands delivery. This belief allows the paper price to serve as a reference for physical transactions. Dealers use the spot price as their base and add a premium. Industrial buyers reference the futures price when negotiating supply contracts. The paper price has influence because people believe it is connected to physical reality. But when the divergence becomes too large, the credibility erodes. When premiums reach $32, the spot price is obviously not the real price. When delivery times extend to 6 weeks, the paper promise of immediate delivery is obviously false. When the Shanghai price is $23 higher than comex, the comex price is obviously not reflecting global supply and demand. The divergence is destroying the credibility that the paper market depends on. As credibility erodes, behavior changes. Industrial buyers stop referencing the comex price and start negotiating based on actual replacement cost. Dealers stop using spot plus premium and start using cost plus margin. Investors stop trusting futures contracts and start demanding physical allocation. Each of these behavioral changes further undermines the paper market. The erosion becomes self-reinforcing. The resolution comes when the paper market capitulates. When enough participants lose faith in the paper price, the selling pressure evaporates. When the shorts realize they cannot shake out the physical holders, they have to cover. When the delivery demands exceed the vault inventory, the exchange has to either deliver metal at much higher prices or declare force majeure. Each of these outcomes results in the paper price spiking higher to reconnect with physical reality. The 40% paper crash was an attempt to prevent this resolution. The banks hoped that crashing the paper price would crash physical demand, refill the vaults, and restore the credibility of the paper market. They failed. Physical demand did not crash. It exploded. The vaults are still draining. The credibility is still eroding. The resolution is still coming. Based on the current divergence, my target for the resolution is a paper price of $130 or higher. This target is derived from the physical price that already exists. Silver Eagles are selling for $108 at retail. Generic rounds are selling for $90. The wholesale price, based on dealer reports, is approximately $85. The comex paper price is $76. The paper price needs to rise to at least $85 just to match the current wholesale price. It needs to rise to $130 to restore the historical premium relationship. And if the delivery crisis forces a squeeze, prices could go much higher. Now let me address what this means for you and what you should do with this information, because understanding the divergence is only useful if you act correctly on that understanding. First, recognize that the paper crash is fake. Do not let it affect your psychology. Do not let it shake your conviction. The paper price is being manipulated by banks that are desperate to avoid delivery. The physical price is holding. The demand is exploding. The fundamentals are stronger than ever. The crash is a lie designed to take your metal. Do not give them your metal. Second, if you hold physical silver, hold it tighter. This is exactly the moment when holding matters most. The banks are attacking because they are desperate. They are trying to shake you out before the repricing occurs. If you sell now, you sell at manipulated lows to the manipulators. You give them the metal they need to avoid default. You surrender your position just before the victory. Do not sell. Third, if you have cash available, buy the divergence. The paper crash has created a temporary discount on physical silver. Yes, the premiums are elevated, but the all-in price of $108 for a Silver Eagle is lower than the $145 it cost at the peak. The paper crash, even with premium expansion, has created a buying opportunity. Acquire physical metal while the paper price is artificially suppressed. When the paper price reconnects with physical reality, you will be glad you bought during the divergence. Fourth, avoid paper silver entirely. The paper market is broken. It does not reflect physical reality. It is subject to manipulation. It may experience delivery failures that result in forced cash settlement at artificial prices. Paper silver, whether in the form of futures contracts, ETF shares or unallocated accounts carries counterparty risk that physical silver does not. The divergence between paper and physical proves that these are different assets with different risk profiles. Own the real thing. Fifth, document the divergence for future reference. Save the charts showing the paper crash. Save the data showing the physical demand explosion. Save the premium data showing the gap between paper and physical prices. This documentation serves two purposes. It helps you maintain conviction during future attacks by reminding you that you were right. And it provides evidence of manipulation that may be useful for future regulatory or legal actions. Sixth, share this information with others who need it. The mainstream financial media is not reporting the divergence. They are showing the paper crash without context. They are creating the impression that silver is in trouble when the physical market proves the opposite. Counter their narrative. Share this video. Explain the divergence to friends and family who hold silver. Help others understand that the paper crash is fake so they do not make the mistake of selling at the bottom. Let me now explain why the 250% demand explosion is sustainable and will continue. Because understanding the durability of demand builds confidence that the divergence will resolve in favor of higher prices. The industrial demand is locked in. The solar industry has contracted for silver purchases that extend years into the future. The electronics manufacturers have supply agreements that cannot be easily modified. The EV producers have committed to production schedules that require specific quantities of silver. This industrial demand is not speculative. It is not driven by price expectations. It is driven by manufacturing requirements. The factories need the silver regardless of what the paper price does. They will continue buying even if prices double or triple because they have no alternative. The investment demand is structural. The stackers who are accumulating silver are not traders looking for quick profits. They are savers who have concluded that fiat currencies are being debased and hard assets are the only protection. This conclusion is not based on the price of silver. It is based on the debt levels of governments, the money printing of central banks, and the inflation that is eroding purchasing power. None of these factors have changed because the paper price crashed. If anything, the paper crash has reinforced the thesis by demonstrating that the paper markets are manipulated. The stackers will continue buying because their reasons for buying are unchanged. The central bank demand is accelerating. China, Russia, India, Turkey, Poland, and dozens of other nations have been accumulating gold and silver for years. They are diversifying their reserves away from dollars and into hard assets. They are preparing for a monetary reset that will revalue precious metals. The paper crash on COMEX does not affect their strategy. If anything, it provides an opportunity to acquire metal at lower prices. The central bank buying will continue because it is driven by strategic considerations that have nothing to do with short-term price movements. The monetary demand is building. As the fiat currency system approaches its terminal crisis, more and more investors are recognizing silver as money. They are moving from paper assets to physical assets. They are opting out of a system that they no longer trust. This monetary demand is in its early stages. The mainstream has not yet recognized silver as a monetary asset. When they do, when the tipping point is reached, the demand explosion that we are seeing now will pale in comparison to what is coming. The supply response is constrained. Unlike demand, which can expand rapidly, supply is slow to respond. It takes a decade to bring a new silver mine from discovery to production. The exploration spending during the years of low prices was minimal. The pipeline of new projects is thin. Even with silver at $100 or higher, the supply response will be gradual. The deficit between demand and supply, which already exceeds 200 million ounces per year, will continue or widen. These factors make the demand explosion durable. It is not a spike that will reverse. It is a structural shift that will persist. The paper crash has not changed any of these factors. The paper crash is noise. The demand explosion is signal. Focus on the signal. Let me now give you my forward outlook for how the paper-physical divergence resolves. The resolution will occur in 3 phases. Phase 1 is premium persistence. Over the next few weeks, the paper price will stabilize or begin to recover while premiums remain elevated. The dealers will not reduce premiums because their wholesale costs have not declined. The physical price will remain at current levels or rise while the paper price fluctuates. The divergence will persist, but not widen significantly. Phase 2 is the delivery crisis. During the current delivery month and the next, the COMEX will face demands for physical silver that exceed the available inventory. The exchange will have to either source metal at prices far above spot, pay massive premiums to convince contract holders to accept cash settlement, or declare force majeure. Each of these outcomes will demonstrate that the paper price is not the real price. The crisis will make headlines. The divergence will become common knowledge. Phase 3 is the reconnection. The paper price will spike to reconnect with physical reality. The manipulation will end not because the banks chose to stop, but because they were defeated by the physical shortage. The short covering will add to the buying pressure. The price will overshoot to the upside as the years of suppression are unwound in months. New all-time highs will be reached. The holders who survived the paper crash will be rewarded. The timing of these phases is uncertain. The banks may succeed in postponing the crisis for weeks or months. They may execute additional attacks to buy more time. But the direction is certain. The paper price must eventually reflect physical reality. The divergence must eventually resolve. The holders must eventually be vindicated. Let me close with perspective on what the paper crash and physical demand explosion mean in the larger context of monetary history. This is not the first time that paper prices have diverged from physical reality. It happens every time a fiat currency system approaches its end. In the final years of the Roman Empire, the official value of the denarius diverged from its silver content. The coins were debased, but the official price pretended otherwise. The divergence resolved when the currency collapsed and the silver content became the only thing that mattered. In the final years of the French assignat, the paper currency diverged from the precious metals it was supposed to represent. The divergence resolved when the assignat became worthless and only gold and silver retained purchasing power. In the final years of the Weimar Republic, the paper mark diverged from the real assets it was supposed to purchase. The divergence resolved in hyperinflation that destroyed the currency and rewarded those who held hard assets. We are living through another such divergence. The paper silver price says $76. The physical silver price says $108 or higher. The paper says abundance. The physical says shortage. The paper says crash. The physical says explosion. This divergence will resolve the same way every previous divergence has resolved. The paper will fail. The physical will endure. Those who trusted paper will be destroyed. Those who held metal will be preserved. The 40% paper crash is the death throes of the paper-silver market. The 250% physical demand explosion is the birth of the physical silver market as the dominant price discovery mechanism. What they do not want you to know is that you are witnessing the transition from one era to another, from paper to physical, from fiction to reality, from manipulation to truth. Hold your silver. The paper crash is fake. The physical demand is real. The resolution will reward those who understand the difference. This has been Silverstorm Daily. Paper silver crashed 40%, while physical demand exploded 250%. The divergence proves that the paper market is a lie and the physical market is the truth. The resolution will come when the paper price reconnects with physical reality. That reconnection will take prices far higher than current levels. Do not be fooled by the paper crash. Do not sell your physical metal. Buy more if you can. The opportunity that they do not want you to know about is right in front of you. Like, subscribe, and share this video with everyone who needs to understand the difference between paper and physical, between manipulation and reality, between lies and truth. The storm is fierce, but the truth is fiercer. See you in the next report.